Good afternoon, everyone. It's 4 o'clock. Welcome to the February version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you, everyone, for taking your time out of your day to join us. If you have any questions during our presentation today, please write them in the chat, and I will ask them to Chris if they are timely. Otherwise, we will get back to you directly or address it in our next MSOM. This month's edition is titled New Year, Same Story, where Chris will walk us through our 2024 outlook. So Chris will focus on the market outlook, nuclear energy, and also the importance of staying invested. I'll pass things over to Chris. Take it away, Chris.
Thanks, Adam. Welcome, everybody. We titled this month's episode New Year, Same Story, as it was another strong year of gains for the S&P 500 and a positive month here in Canada for the TSX. Both led sharply higher by the technology sector. We saw a 6.7% increase in the small technology sector we have here in Canada, and it was that magnificent seven leading the charge again stateside. The rally was fueled by strong economic data once again in the United States, with non-farm payrolls advancing 353,000 new jobs created in the month of December. That was exceeded expectations and was also coupled with a revision to last month's opportunity. This strong labor force has, however, hindered the Fed and the expectations of the Federal Reserve to cut interest rates anytime in the near future. This was echoed by Jerome Powell last week in the 60 Minutes episode, following which the expectations for a March rate hike shrunk from 70% to below 20%, where they sit here today. A lot of that is on the strength of the labor market. You can see that in the chart on the bottom left. We're showing that average hourly earnings is starting to tick up, meaning employers are starting to have to pay more to attract workers, and you're seeing that upward trajectory in the non-farm payrolls that continue to add economic support to the United States economy. Couple that with an improvement on the manufacturing side and rise in new orders. This was a leading economic indicator that ourselves and strategist Martine here at Canaccord Genuity had been watching as a forward-leading kind of negative indicator. As you can see in recessions, that downdraft typically is followed by one of these gray bars, which indicates a recession. Unfortunately, the results have not been as rosy here in Canada. Canadian GDP is expected to print a negative quarter in Q4. That follows a negative print in Q3, which would pose a technical recession. Challenges headlined by productivity losses and slowing immigration gains. The Bank of Canada also reiterated their desire to pause at 5% overnight lending rate. A little bit of a different mandate than the United States. They have an inflation target at 1 to 3%. They're nearing that upper bound of 3%. And our expectation would be that they could potentially go first on the rate cuts, although you don't tend to see much divergence between the two central banks. So they may play the wait and see card as well. But Canada, as we were alluding to on the other page, has not done quite as well. The Bank of Canada expects about 65% of all mortgages in Canada to have reset by the end of this year, since the start of the rate hikes about 2 years ago now. The loonie has held in all right. We had a pretty decent trade surplus last month, led by wheat exports. But we still have the expectation that bond yields move lower, not higher from these levels. That should bode well for interest rate sensitive securities, things like banks, real estate investment trusts, utilities, telcos, all of which are heavyweights in the LWC Canadian dividend portfolio and offer a great opportunity on the entry point. Conversely, stateside, the US market continues to get expensive. We've seen earning expectations declining while stock prices are increasing. The only way that happens is through multiple expansion. The S&P 500 on average sits at over a 20 times price to earnings ratio. We're showing that here on the chart on the bottom right, and you see kind of the divide between Canada and the United States, which has gotten even wider in recent months, presenting a relative value trade. This coupled with a strong put to call ratio, that's essentially people betting that stocks go higher versus lower. It's a sign of greed in the market. Couple that with the yield on the S&P 500 falling to about 1.5%, not a very good comparison when you're looking at the rate environment we're sitting in. So although those stocks have done tremendously well off the 22 lows, we are warning a sign of caution that they could be running out of steam. However, the momentum is still there, and we do own some of those names. Nvidia, we added to our Tesla position, which is starting to waver from being inside that Magnificent Seven and looking at opportunities in the technology sector that may not have kept up quite as well. We have had some nice wins on the Canadian side in tech as well, with a position in Converge Solutions, a tech company here in Canada that we've been heavily in favor of over the last several months. Switching gears, nuclear power, a theme that we're extremely excited about, has done fantastic in the last year or so. We've taken a position in a company called Stallion Resources, owns a large land package in the Athabasca region, right around a lot of these big nuclear mines. Nuclear was the soup du jour at the COP28 climate change conference in Dubai several months ago, where the United States, Canada, the United Kingdom, France, and others pledged to triple their nuclear capacity by 2050. Nuclear, albeit not renewable, is an extremely clean source of energy. Compared to coal, as an example, a gigawatt of coal creates about 820 tons of carbon emissions, where a gigawatt of electricity produced by nuclear creates just 3 tons of that emissions. Nuclear has got a bit of a bad rep from a couple of issues in Chernobyl, Fukushima, all of which, even at those times, could have been avoided with the technology available at that time. It simply wasn't, the money wasn't spent on it, and the catastrophes did happen. However, a lot of those issues are now behind us. The ability to enrich nuclear waste into weaponized items is really blown out. The ability to do that is not very easy. And then lastly, there is an advancement in what's called small modular nuclear reactors, SMNRs. They are potential game changers. They're like mini portable power stations. They can power things like oil camps or off-grid areas, small cities, rural locations, and they're gaining in popularity. And the difference between nuclear and solar and wind, as an example, is those are intermittent power sources. To replace coal, you need to be satisfying baseline power, and unfortunately, wind and solar cannot do that. And there is also a transfer loss of energy converting the wind or solar into a battery and then out back into the grid. Here at home, the Ontario government's probably about to announce a multi-billion-dollar refurbishment of the Pickering nuclear reactor power plant and looking at expanding that into other areas of the country. So this is a theme that we're looking to gain exposure to and think that it's worthwhile taking a look at on weakness. Lastly, we just get a lot of questions around market timing, clients bringing in RSP, TFSA money, wondering if now is the time to deploy that. The short-term market timing game is not one that we recommend people playing. The chart on the bottom left shows you that since 1980, if you invested $10,000 in the S&P 500, that would be equal to $451,000 today. If you just were out of the market for the 5 best days, you'd have 38% less of that capital pool. So we recommend either getting invested and staying invested, or having a regimented deployment plan, whether it's putting in a third over a 3-month period. But all of this is to help avoid the behavioral biases that we all suffer from that root themselves in both fear and greed. In order to overcome those biases, one of the best ways is to take time, think about it, and work with someone else, like a trusted advisor, like the great team members I have here, Matt, Lindsay, Maria, Mitchell, Adam. All of them are fantastic professionals that can help and do help our clients walk through these challenging times and battle those fear and greed moments, to stay invested, to get invested, to take a disciplined approach, allowing me to do my job on the due diligence side to build strategic, diversified portfolios that are going to win over the long term. Um, and that's shown, people that have an advisor echo those points on having the peace of mind to meet their retirement goals into the future and don't let it all rest on their own shoulders. So with that, I'll wrap it up.